Hi everyone, Bob Massey here, and I just want to visit a different topic today. I get a lot of phone calls from investors and our members, and they're asking questions about the tax implications to the seller of the house when a short sale gets done. And I think everybody knows that the difference between the amount owed on the property and the amount of the short sale is 1099 from the bank to the seller, and that is counted as taxable income. There are some exclusions to that, and I thought we'd visit on those briefly. Remember, I'm not a tax accountant, I'm not a tax attorney, so make sure that you seek your own counsel and have your sellers talk to their own counsel to make sure that they get proper answers regarding the federal tax. State tax is a totally different issue. But let's take a quick look. First of all, a simple case. If the owner of the seller has been living in the house as their primary residence for 3 of the last 5 years, that is covered under a ruling that lasts until the end of 2012. So if the discharge took place between 2007 and the end of 2012, and the gain was against their primary residence, there's no tax implications at all. It's waived. In the event, and here's where a little questioning comes in, a question mark comes in the event that the house was a second house, vacation house, something of that sort, the letter of the rule says it has to be the primary residence. So the reading right now on that, and I have not heard that there's been anything different, is that that would not count under the primary residence exclusion, and there would be a tax liability for the gain unless the property was used for business purposes. And there is a whole section of the code that talks about using that real property used for business purposes, and that ends up getting a discharge of indebtedness that, number one, it can be wiped out if there's a Chapter 11 filing, and number two, it can be wiped out if it's a genuine business and netted against the business profits of the company. There is a third way that it could be done, and that is if the sellers are insolvent. There's a ruling by the IRS that says they do not owe the tax on the discharged amount if they're insolvent, and there's a whole calculation that has to take place to show them, to actually calculate out how much they can be forgiven and how much they still have counted as regular income. So those are things best left to an accountant, but probably the biggest questions that you get day to day are about the primary residence and about second home. So hopefully this has helped you a little bit, and it's a very key topic for our sellers, and so the more you know, so that you can at least tell them the right direction to go to get proper counsel and proper direction, that's a great thing. So hopefully that helps you. Have a great day and great selling.